Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, March 28th, and then we'll see how things look for Wednesday, March 29th. Had kind of a sleepy day, down a little bit, a little more negative side, but still in the short term, we're looking positive, even though we're seeing a real decrease in volume, so there's a real lack of conviction right now. But overall, things are continuing to hold up. But as I said in yesterday's video, a good solid down day could wipe out any of the positive things that we're seeing. One piece of information to take care of, please be reminded from April 22nd through May 11th, I will be traveling. I intend to post the videos at least each day. I'll try to do the weekly video and the intermarket analysis video and the deep dive video. I can't guarantee all of this right now. I need to have access to the internet, and that's always a little bit dicey the way I'm going to be traveling this time. I have launched a podcast on YouTube. It's the same as these videos that you're watching right now, but feel free to check that out if you like podcasts. And for the video on YouTube, Rumble, and the podcast, I do have PDFs of all slides and charts. If you want to look down in the description box, I post a link with each video that you can follow along with the different charts that I'm referring to. All right, let's go back and talk about what happened. At the open, we had a lower open. There wasn't much of a gap. Prices fell down to S1 at 39.64. After that, we climbed almost back up to the unchanged level. As the day went on, we fell again down to S2 at 39.51 before bouncing back and going above R1, and we actually returned to Friday's close. So in the last 2 days, we've gone nowhere. It's been a big treadmill. We were down 0.16%, which is what we were up in yesterday's session. Volume has really been dropping off. And as I said, our technicals in the short term, they're still hanging in there positive, but that could change quickly. Intermediate term, they're looking a little bit better. Long term, we're still above the 200-day moving average because of this whole inflation and interest rate scenario and more concerns about the whole banking situation and what that could lead to. Here's the intraday chart showing how we had a lower open, came down to S1, tried to set up a bit of a base here, bounced back up, almost got back to the unchanged level before then going down to almost S2. We rebounded up off of that, came back above S1, and actually closed a little bit higher on the session from previous lows set in the day. Here's a look at the value versus growth. Both ended up being down overall, but saw some late day strength. Here's a look at how growth underperformed value with the large caps as well as the mid caps and the small caps. So that's biting in a little bit to our possible positive scenarios that I'll show you later on. Here's an intraday look at the SPY. After the close on Tuesday, we pretty much drifted sideways. Then we got into the overnight session where we saw some weakness. That carried a bit over into the open. Then we were down throughout most of the session only to see some late day strength. And currently we're a little bit higher with the SPY in the overnight session. What are some comments that we can make? Small caps and mid caps did outperform. We also saw that after Monday. And this is also the same. Those areas that had been showing strength recently, they are now seeing some weakness. And some areas of weakness are now seeing some strength. One of the Fed members did testify before the Senate Banking Committee and said that he anticipates having to increase capital and liquidity standards for firms over $100 billion, adding that more regulation is needed. That's addressing the banking situation. And the market seemed to like that and got a little bit of support from that, the fact that something is being done in that regard. Other folks are like, oh great, more regulation, more rules, more hoops that everybody has to jump through. Just depends on where you come out on that. On a short-term basis, we still have our Stochk RSI that's extreme positive, but we can also look at that as a momentum indicator to show us that we are going up more in the short term. The dollar was down and interest rates were up. That's the same as after Monday's session. We still have the 30 to the 5 that's back to a normal yield curve with all of our other yield curves remaining inverted. Sentiment was unchanged. It had been at 38. It came in at 38. And our trend is still negative and weakening. The red line's still on top, so that's negative in the background, but we're also below 20 with the ADX. I've switched our bias and our momentum to mixed because we're just treading water right now. The economic reports that came out, the advanced report for international trade and goods came in at 91.6 billion. Last time it was at a mere 91.1 billion. Not real influential, as well as with the next report. The advanced report for retail inventories came in up 0.8%. Last time it was up 0.1%. The advanced report for wholesale inventories up 0.2%. Last time it was down 0.5%. The FHFA housing price index came in up 0.2%. Last time it was down 0.1%. The S&P Case-Shiller home price index was up 2.5% as expected. Last time it came in up 4.6%. And then finally, consumer confidence came in at 104.2. They had expected it to come in at 101.5, so that was a little better than expected and a little bit better than last time. And then a year ago, consumer confidence stood at 107.6, so people are a little more negative than they were last year. Looking at the Isabel net charts, this chart basically just shows overall when we're below zero that folks are not assuming as many risk assets right now with their stocks. When we're above the zero line, folks are getting more into stocks. When we're below this line, they're more out of stocks. This chart is a little convoluted. This refers to a thing called equity risk premium. This is when you have a bunch of money and you put it into something to generate interest. Well, you have some risk-free investments like treasury bonds, but those give you a very small return. So you're looking for a better return. So you take that money and put it into something more risky, such as stocks, and then you're paid more for that. It's risk versus reward. This tries to measure that. It's starting to go back up, which according to Morgan Stanley is that there's more risk starting to come into the market. On a technical level, we're just about at the midpoint now between being overbought and oversold. We also look at the NFIB small business availability of loans. That's the dark blue line. And we look at initial jobless claims. Since most companies in the U.S. are small companies, if companies are having trouble getting capital, they're going to also have trouble keeping employees. So this has a tendency to have a pretty strong correlation. The jobless claims continue to fall. This is inverted, where the availability has been going down, and so we're seeing a pretty wide spread between these two. What's likely to happen? Are loans going to become more available, or are we going to see an increase in jobless claims? It's looking like the next piece to fall in the economy would be the jobless claims going back up, so that could hurt the employment situation. Another chart just measures the number of bank failures so far this year. The interesting word is so far. Bank failures are few, but they have been very influential and they're really gaining a lot of traction in the news cycles. Looking more at money market funds, where it says the past 2 times that cash balances have really gone up, the Fed has slashed rates. So we're wondering if that's going to happen. This light blue line is the Fed funds target rate. The dark blue line are money market assets. They're coming more in line with each other. Does that mean that we could be topping out as far as interest rates? Then looking at the Real Investment Advice blog, the headline for their post that they publish pretty much every day says that bullish buy signals mark 4,200 for a relief rally. And then to quote what they said, despite an ongoing banking crisis, investors continue to chase stocks, triggering several bullish buy signals, and that's what we're seeing in our charts. As noted in this past weekend's newsletter, which I referred to in yesterday's video, 2 primary reasons exist for this current dichotomy. The first is psychological, and the way that they're presenting it in this article is it's Pavlovian. Remember Pavlov with the dogs? He would turn on the light or ring a bell, and the dogs would salivate. If they saw the light, they thought they were getting food, even though they didn't see any food. They're thinking that's what's happening with the market right now because the markets have been conditioned. When things go wrong, the Fed and the government jump in to try to fix it so nobody feels any pain. That's what they're suggesting is going to happen right now. Even though this banking situation is negative, we've got all kinds of leaders in the government saying, don't worry, everything's just fine. We're going to jump in. We're going to do this. We're going to do that. And that is starting to calm down the markets and helping them feel a little bit better. Then the second thing they're looking at right now is technical, and I have a few of their charts, which kind of mimic the charts that I show you, that I'll go through here in just a second. This chart down below just shows how the Fed balance sheet has really gone back up. This is not quantitative easing. It's the discount window and that action that's taking place that's producing a lot more assets onto the Fed balance sheet. The difference between quantitative easing is they're going out and buying bonds, which releases capital into the economy. When they go to the discount window, that's a loan that they actually have to pay back, so it's a little more stringent in that regard. Here's a look at their technical charts, and I showed this over the weekend. Their money flow indicators are turning up. The stochastics are starting to go higher. Their money flow indicator is above zero, and the MACD is also crossing above. And we look at all these indicators as well. And on this chart, they're suggesting with the Bollinger Bands that they have plotted that resistance is at about the 4,200 level. And then up above, you can see where the MACD is crossing over positive, which is the same thing that we're seeing right now. And then here's another chart showing more of a close-up of the MACD and also the resistance level overhead if you really rely on Bollinger Bands to set support and resistance. Then at the end of the article, they say, however, with these buy signals, investors should modestly increase equity exposure as the likely path for stocks is higher over the next 2 weeks to 2 months. As shown, the most likely target for the S&P is 4,200 before serious resistance is encountered and a reasonable level to take profits and again reduce risk. One thing they're likening what's happening right now is to what happened back in the financial crisis with Bear Stearns, where they say, remembering Bear Stearns, the obvious question is, how could markets possibly trigger bullish buy signals and rally amid a global banking crisis? That's what happened back in 2008, and that's what a lot of people are wondering about right now. We've got this banking crisis that's going through the system. We don't know if there's more yet to come, but when the Fed steps in and does something, the market tends to rally off of that, even though that tends to really go against logic. It still happens nonetheless. We're not really seeing that yet, and we didn't see that in Tuesday's session, but that's why some of our charts are looking better when people are going, wait a minute, things are falling apart here. We should be going down. Well, because they're seeing some intervention, that's helping to calm a lot of fears and producing a little more confidence to buy. Then their conclusion is, as noted above, we have a similar setup in the markets currently with negative investor sentiment, and that's what we're seeing in our sentiment indicator, and reassurances from the Fed that the banking system is sound and resilient. While we may see many similarities in the financial system today, that doesn't mean markets can't rally solely based on hope and optimism. A rally toward 4,200 is possible, as investor psychology is not always logical. It is emotional, and emotion and logic don't often go hand in hand with each other. Feel free to go to the link that I have provided right here to check out their full article. And they post pretty much every day, and then at the end of every week, they have a newsletter that you can access. Also, Edward Yardeni posted a chart just comparing job openings and if they're plentiful or not. The red line just shows that we're still up overall, but we're starting to decrease, both with the red line and the blue line. So we're keeping an eye on this, because that's the last shoe to drop for the Fed justifying taking rates higher, is that the employment situation has really been holding up well. Now, getting into some of our charts, we're seeing a real drop-off in the Ulster Index. We're chopping sideways over the last few days, and this indicator picks up based on price, and that's really dropping the overall fear gauge. Also, with the VIX, we're seeing a decline on the line chart as well as the bar chart, and volatility of the VIX continues to drop as well. The equity put-call ratio, we're keeping an eye on this. We did spike up over 0.8 and we're coming back down. We tick back up a little bit, but we're watching the overall movement of this indicator because that often gives some good support to the S&P. Another fear gauge that we looked at was pretty much flat, but still starting to tick up just slightly when you compare shorter-term bonds with investment-grade bonds. Another fear gauge that we look at looks at shorter-term bonds and the S&P 500 equal weight ratio, where it ticked down just slightly, but it has been spiking up lately, showing fear is increasing. And then we look at high beta stocks. When we're going up, that's risk on. Well, we've been coming down now, so that's more risk off as folks get out of stocks into bonds. Condition of our trend, the ADX is below the moving average and declining. We're also below 20, so we are in a trendless environment. However, we default to the negative with the red line on top. Looking at the daily chart, we're still in between the 200-day moving average below current price and the 50-period moving average above current price. We're also above the downward sloping trend line, so the market has been holding up so far. If you look down below, you can see where volume really dropped off in Tuesday's session. Here's a 2-year look at that same chart showing how things have been holding up still. Our RUN is showing a lot of improvement. It's starting to go back up, but it's still negative overall. And looking at our Keltner bands, where they're placed 1, 2, and 3 standard deviations above and below current price, we're just a little above the dash line, which is the midpoint. Stochc RSI, this is our one extreme positive indicator where we're still above the 0.8 level, which is still suggesting there could be good momentum, but we're seeing a decrease in volume. Williams %R ticked down a little bit, but is still above 50, so that's positive. Our short-term stochastic rolling over a little bit. We're still going up with the intermediate-term stochastic as well as the long-term stochastic. The force index, even though it declined, it's still above 0. And we're still above both the simple and exponential 20-period moving average. We're right at the bottom side of the 50-period exponential moving average, where we had been in between the two. And we're just a little bit above the 100-period simple and exponential moving averages. We're right in the middle of the moving average tree, so hard to really get much from that. This is a more negative. The Swinland Trading Oscillator, based on price and volume, have started to roll over, but they're still above 0, so we'll be watching this. Even though based on volume we've dropped a little bit below 0. Our oscillators are positive. Short term they're going up, intermediate term, and starting to cross over positive longer term. The parabolic SAR still has the dots underneath, so that is positive. Chaikin oscillator still above 0, so that's positive, but has been declining. The vortex is negative with the red line on top, even though it is declining. The ultimate oscillator still below this 50 point, but turning back up slightly. Ichimoku cloud, can we get back up into the cloud? We haven't done that yet. And then can we eventually break above that cloud? Looking at the PMO, we're just crossing over with the PMO. We've already crossed based on price and volume. And then the PMO study showing that the percent of PMOs that make up the S&P 500 are improving. The buy signals are improving, and we're flattening out with the PMOs that are above 0. Looking at the bullish percent index, I went through this a little bit yesterday. We're bouncing up after giving an extreme negative reading. That's what we're focused on right now. But we're also looking at some negative divergences, which has already happened, as well as this positive divergence, which could still be developing. The NYSE bullish percent index went up just slightly, but has still been declining overall. The Chaikin money flow did see some improvement and is above 0, so that's more positive. The balance of power is above the dashed line, although it did decline slightly. We're starting to turn a little more positive with the TTM squeeze, and we're still deep purple with the go-no-go system, which is negative. And we maintain price above the 200-day simple moving average. Short-term fib levels hasn't changed since the last video. We're at 4,004 to the upside and about the 3,905 level to the downside. Our longer-term fib chart showing some overhead resistance at 4,000 if we continue to go up. Longer term, we have overhead resistance at 4020. We have support at the 3826 level. The S&P 500 bigger stocks are still outperforming the equal weight index, but we have been falling back the last 2 days. The Elder Impulse system for the S&P remains positive. The McClellan oscillator showing improvement above 0, so that's positive. The broader look at the McClellan oscillator has crossed above 0, so that's positive. Our summation index based on price is turning up as well as volume, so that's positive. The new highs, new lows are starting to turn up with our 5-period and 10-period moving averages. The advanced decline line based on price, we're still above the moving average, but we're seeing a negative divergence here with price not confirming that. The advanced decline ratio showing some improvement with our shorter term moving average and still going higher but negative with our longer term moving average. Accumulation distribution still above an advancing moving average. That's positive, although volume is really dropping off. The financials bouncing a little bit after just getting hammered. The bank ETF was down just a little bit in Tuesday's session. Looks like it could be building a base. The regional bank ETF was up 0.71%, and the other regional bank ETF was down 0.09%. The ratio between the regional banking ETF and the financial sector is showing a little bit of improvement after really going down. And First Republic was down 2.32% to close at $13.50 per share. The Dow were still above the 200-day moving average. The diamonds continue to be positive. The Nasdaq is also showing a little bit more weakness. It was down more than the S&P. We've dropped down below this pivot level right now, but we're coming off of a recent golden cross. And the Nasdaq 100 also dropped down below this pivot level after giving a recent golden cross. The Qs for the Elder Impulse system remain at neutral. If the Nasdaq 100 does advance, we have overhead resistance at this 38.2% retracement level at the 12,868 level. And keeping an eye on the micro cap index, which was down 0.5% after just setting a recent 52-week low. The small caps were up 0.1% and support continues to hold. And here's the Russell 2000 small caps where the MACD is trying to turn over positive. We're maintaining the support level, and the RSI is showing a little bit of improvement, but still below 50. The small caps for the Elder Impulse system remain at neutral. The ratio between small caps and the S&P 500 after really breaking down did tick back up slightly. The mid caps were also up 0.29% and remain neutral with the Elder Impulse system. The home builders were looking at this relationship where it's starting to go a bit in opposite directions. We'll keep an eye on the home builders, and if that happens, then I'll explain what that means and how we can interpret this chart. The Copic curve gave us a recent buy signal, as has the Pring bottom fisher. Bonds are seeing interest rates going back up. We're back up over the 3.55% as bond prices continue to fall. Then looking at our long-term trend analysis, nothing has been decided here. The MACD is still right on top of the moving average. What we're trying to do, if you're watching this for the first time, when we broke out above this downward sloping trend line, that looked like a breakout. Now we're trying to determine, was that for real or was that a fake out? We're still above this based on price. But at the time we broke out, the MACD was a lot stronger, and now it's rolling over. If the MACD continues to show some weakness, and we drop below this trend line, that could suggest that the breakout was a fake out. An update of our possible positive scenarios, a little bit of improvement based on price. When we look at our 19-day exponential moving average of the advanced decline ratio, we're still below zero based on volume. And we're seeing a little bit more weakness with our growth to value ratios. When you compare the Qs to the S&P, discretionary is a little bit weaker, and large cap growth to large cap value. And then looking at our growth to value ratios, the large cap, a little bit of weakness, mid caps and small caps, but they're still above the moving average. This is also another chart we're looking at, the 50-day exponential moving average of the new highs minus the lows. We have dropped below zero. However, looking at the indicator, we remain positive, so that could turn it back up. But this is a pretty slow indicator, so it's going to take a while for that to improve. 2-year Treasury yield, after spiking up, has been coming down. Often that gives support to the S&P, but we're not seeing that yet. Then looking at the staples to S&P 500 ratio, we're coming back up. We could take out this spike and continue to go higher, and then if we turn back down, that would be a new spike to work from. So what is our outlook for Wednesday? The technicals are same as what I said yesterday. They're turning positive. We're not really going up with much strength, but we're not going down that much either. But that could change at any time. We have the weekly MBA mortgage index coming out, as well as pending home sales, and then the whole list of geopolitical events. We're waiting for more banking information, if that is forthcoming. The Fed speak, we did have a speech on Monday. Vice Chair Barr did speak on Tuesday. He will resume his speaking on Wednesday before the House. There's also 2 other speeches coming up at the end of the week, but they will be after the market closes. Looking at the Stock Traders Almanac statistics for March 29th, we're negative overall. The Dow, the S&P, and the Nasdaq are only up 42.9% of the time across the board. And then we have these other things which should be adding to our positive backdrop because we're not really moving. I'm not going to take the time to go through that. Also, next week when we switch over into April, this whole slide will look much different. We're on the 21st trading day of the month. We're looking at the green dashed line, which shows a bit of positive action for the S&P. And then just to show these charts again, we're supposed to be in this positive seasonality right now, which is the gray line, because we are in a pre-election year after we had a bear market last year. And this chart also suggests the gray line is supposed to be a sweet spot for the S&P 500, but we're just not seeing that yet. Our scenarios: can't really go with the down one because we're not trending. Can't go with the up one because we're not trending. We're still going sideways overall with the ADX weakening. It's below 20, and it is negative with the red line on top. Our conclusion: the S&P, it is improving, but it could go away pretty quickly if we see some downward movement. We're still positive in the short term. We're improving in the intermediate term. We're still positive in the long term because we're above the 200-day simple moving average. And it seems like a while now, but we had a recent golden cross. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.